Hello class, let's take a moment to go over some Chapter 6 Merchandise Inventory Cost. This will be a brief 15-minute presentation. How are merchandise inventory costs determined under the perpetual inventory system, which we'll be going over as perpetual. Inventory costing method approximates the flow of inventory costs in a business that is used to determine the amount of the cost of the goods sold and ending inventory. 4 basic inventory costing methods allowable by GAAP, generally accepted accounting principles, are specific identification, which we won't be covering too much, but this would be like an automobile, which has a VIN number, which identifies that particular item for inventory. Calculations we'll be going over is first in, first out, last in, first out, and weighted average. First in, first out method assumes the first units purchased are the first ones sold. And this is just the cost, not the item itself, but the cost of that item. Cost of goods sold is based on the oldest purchase. Ending inventory closely reflects current replacement cost. Cost of goods available for sale is the total cost spent on inventory that was available to be sold during the period. So this is a first in, first out inventory card. This is all it costs. There's no retail amounts here. These are all just costs. And all three will start with the same beginnings. August 1st, this would be the beginning balance. And these are calculated by purchases. Units times cost gives total cost. Same thing with cost of goods sold. Units times cost gives total cost, and inventory on hand, the quantity times unit cost gives the total. So we start off with 2 units at $350 a piece for a total of $700. Then we purchased 4 more units at $360 a piece for a total of $1,440. Every time we make a purchase, we bring down our old inventory. So we brought down our old inventory of 2 units at $350, that's for $700, and we have 4 more units at $360 for $1,440, for a total of $2,140. Keep thinking of these separately. We don't have 6 units. We have 2 units at $350 and 4 units at $360. In the next entry, we sold 4 units. Okay, using the first in, first out, I don't have 4 units to sell at that level. So I'll sell 2 units at $350 for $700, and I'll sell 2 units of the $360 level for a total of $720. The total together, $1,420, and that leaves me with 2 units of the last level that's left at $360. So this is my ending balance, 2 units at $360. I sold 2 units at $350, and I sold 2 units from the second layer, which leaves me 2 units left from that second layer. Then we had another purchase on the 26th of 12 units at $380. 12 units times 380 comes out to $4,560. We bring down our old inventory, 2 units at $360 for $720, and now we have 12 units at $380. For $4,560. Total, $5,280. Then we sold 10 units. Okay, I don't have 10 units to sell on the first level. I can only sell 2 of those units. So I sold 2 at $360 to wipe out this layer. Then I sold 8 of these 12 units at $380. Multiplied out for a total of $3,760. That leaves me 4 units left of the bottom layer here. So I sold 8 out of this 12. That leaves me 4 units left in ending inventory at $380 a piece for a total of $1,520. So I purchased 16 units for a total of $6,000. I sold 14 units at $5,180, and I have 4 units left, which include the original 2 units, for a total of $1,520. Next, we'll go over last in, first out. So we'll take from the bottom level. We'll keep things the same, but we'll take from the bottom level. This inventory is sold as the cost of the newest inventory item is assigned to each unit of the cost of goods sold. So you see that we start the next one for last in, first out, with the 2 units, beginning inventory at $350 for $700. Then we bought another 4 units at $360 for $1440. So we bring, every time we make a purchase, we bring down the old inventory, we bring over the new inventory. Now I have 6 units, but I have 4 units at one level and 2 units at the other level at a different cost. So now when I sell 4 units, we're taking from the bottom level, last in, first out. This was the last units we purchased, so they're going to be the first ones out. So now I can sell 4 units because I have 4 units at $360. So I sold them 4 units at $360 for a total of $1440, which leaves me the 2 units that I had previously at the beginning for $350 for $700. Then I purchased 12 more units at $380. So every time we make a purchase, I bring down the old units, 2 units at $350 at $700. And we have 12 units, the newest units, at $380 for $54.60 for a total of $52.60. We make a sale of 10 units. Now I have 10 units to sell now because I'm taking from the bottom layer. So I take 10 units from the bottom layer. The cost is $380. I multiply it out for $3,800, which now I've sold 10 out of these 12 units. So I bring down my old 2 units at $350, and I have 2 units left from this 12 units after I sold the 10, 2 units at $380. So I've purchased 16 units for $6,000. I sold 14 units for $52.40, and I have 4 units left. The 2 units that I had left over from the last purchase and the original 2 units that I've had. So you'll notice that we keep taking from the last in that came in, the last numbers that came in, rather than the first, which allows the oldest inventory to be down the bottom. The next we have a weighted average, which will come up between first in, first out, and last in, first out. It computes the new weighted average cost per unit after each purchase. Weighted average cost per unit is determined by dividing the cost of goods available for sale by the number of units available. This is important here. So the weighted minus the average cost per unit equals the cost of goods available for sale divided by the number of units available. Ending inventory and cost of goods sold are based on the same weighted average cost per unit. So again, we start with 2 units at $350. It's our beginning inventory at $700. Then we bought 4 more units at $360 for $1440. So it's the same so far. But now we have 6 units because we're averaging. We have these 4 units plus these 2 units. And what we do is we pass by the unit cost and go over to the total cost that we have. This $2140 is the $700 plus the $1440. So that's the new total that's in cost. We divide that by the new 6 units, 4 here and 2 here, and that gives us the $356.67 unit cost. So we're doing the unit cost a little bit differently. We add in the units together, so we get the total units. We add the total cost together, so we get the total cost, then divide by the total units to get the unit cost. Then we sold 4 units. Well, I have 6 units at $356.67. So I sell 4 units at $356.67. That comes out to a total of $14.27, which leaves me 2 units at $356.67 for a total of $713. Then I bought 12 more units. Okay, so I have 14 units total. 12 units at $380 for $45.60, and I have these 2 units at $356.67. So I have a total of 14 units. And then when I add the $45.60 and the $713, it comes out to the total $52.73. Then I divide that by the 14 units and gives me a new unit cost of $376.64 per unit. Then when we sell 10 units again, we sold 10 units at $376.64 for a total of $3,766. 14 minus the 10 leaves me 4 units at $376.64 for an ending unit inventory of $1,507. So again, we've got the 16 units, we've got the 14 units for the cost of goods sold, and we have 4 units left, which are the last 4 units. Next, we'll go over the lower of cost to market. At the end of the year, if the replacement cost for an item of inventory is less than its cost that are on the books right now, then we'll have to lower that cost using the conservative principle, so that the lower cost, so the expense will be in the same period, the matching principle. So let's take a look at that. So Smart Touch Learning paid $3,000 for its TAB 0503 inventory. By December 31st, it can be replaced for only $2,220, and the decline in value appears permanent. So that means the cost to replace it is less than the cost that we purchased originally. So in that year, what we would want to do is the change in the difference, 3,000 minus the 2,250. We want to take that cost of goods sold, that expense in this year, the current year, December 31st, and not bring it over to the next year. So we're basically writing down our inventory cost per item. Next, we'll go over inventory turnover. This is a ratio that we use to determine how many times per year our average inventory turns over. So how many times we make profit. So it's the formula is cost of goods sold divided by average merchandise inventory. So average merchandise inventory, we take the beginning merchandise inventory plus the ending merchandise inventory, add them together and divide by 2. Okay, that'll be the first thing that you do. Then you take the cost of goods sold and divide it by the average inventory. This means that the company averages 8.7 times per year that they sell their inventory. And remember, the more times they turn it over per year, the more money that they will make. Next, we take the days sales in inventory. We take 365 days and divide it by the inventory turnover. So we've got the inventory turnover before, so we divide 365 divided by 8.7, and it tells us we sell our inventory every 42 days. So this is comparable to the 8.7 times per year. So we're actually selling our inventory every 42 days. So maybe we would like to compare that to the industry average, our competitors, or maybe get it down to 30 days. Maybe we could offer a discount for people to pay early, or lower our prices, or just change our credit days that we allow. Instead of allowing for 30 days to be paid, maybe we can bring it down and we can pay it out.